Hello, gorgeous. So good to be with you. So, I have been doing a series for the year end on bite sized nuggets of how to save money at the end of the year on your taxes. And today I want to talk to you about charitable contributions. Now, charitable contributions, I think, kind of ring in our head as being tax deductible. But the first and most important thing that I want to bring up when it comes to charitable contributions is that most US taxpayers don't get any deduction for their charitable contributions. This really stinks, but it is the fact. All right. I think it especially stinks because you can look at studies of low income people in the US, and it's the lowest income threshold people who give the most proportion of their total income to other people. And that makes sense because those are people actually really living themselves amongst a lot of need and giving to the people in their lives, right? So if I were, if I could wave my wand and change the tax code, what I would do is definitely come up with a way to make charitable donations at least equally beneficial to all taxpayers and not just to some. But let's jump in and talk about who actually does get charitable contributions and then some workarounds if you fall in that bucket of people who don't. All right, so here we go. The first thing to understand is that your charitable contributions go into a bucket on your tax return called itemized deductions. All right. And what's important to know is whether or not you itemize. Only about 10% of US taxpayers actually itemize. The rest of us, the other 90%-ish, take what's called the standard deduction. So let me real quick remind you or explain to you how the standard deduction versus itemizing works so that you understand where charitable contributions actually do count and if maybe you're not one of the people who gets any deduction for them. All right, so every US taxpayer gets an initial chunk of income tax-free, right? All of us get a tax-free chunk of income. Now, we can either get that tax-free chunk in a fixed amount, and that fixed amount has a name, and it's called the standard deduction. So think of standard as like fixed, although it's adjusted for inflation, so it goes up a little bit each year. Or you can get a variable amount tax-free. Now, you're allowed to take the one that's bigger, and so the logic is really easy. You take the one that's bigger. So you're only going to itemize if you have itemizable deductions that are bigger than the standard deduction amount. Now, in 2017, when the Tax Cuts and Jobs Act was passed, and reminder, this was passed when Trump first got into office and there was a Republican Congress. And so they did this in the first 100 days. And I'm saying this to you because guess what? This is about to happen again. So in the Tax Cuts and Jobs Act, they doubled the standard deduction at that time. And what happened was this effectively kicked a lot of people who used to itemize down to being standard deduction takers. Anyway, that's just a little background. But here's what the standard deduction is for 2024, this year, the end of this year, and then for 2025. So moving on to next year. It's $14,600 if you're single for 2024, and that bumps up a little to $15,000 for 2025. Double those numbers if you're married. So $29,200 if you're married filing a joint return, or $30,000 in 2025 if you're married filing joint. Okay, so that's the standard deduction. Let's just call it $15,000, even though it's a teenth lower than that this year. So what is itemizing? Itemized deductions are these special categories of deduction that, please note, have nothing to do with your business. So don't tune out about that. So itemizable deductions, you add up your itemized category deductions into one bucket. And if that bucket outweighs the standard deduction, around $15,000, then you will itemize. Okay. So what are those four categories that go in the itemized bucket? They are charitable contributions, ding, 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 plus medical expenses once they exceed 7.5% of your adjusted gross income. AGI, adjusted gross income, is a number you can find right on the front page of your tax return. Mortgage interest, and state and local taxes capped at $10,000. Okay. Those four things are called itemized deductions. All right. So when you add up your mortgage interest, your medical cost, your charitable contributions, and your state and local taxes, if that amount exceeds roughly $15,000 if you file single, or roughly $30,000 if you file jointly, then you are in that 10-ish% of taxpayers who itemizes. I want to just give you kind of a baseline and say, if you're listening to this podcast, you probably don't itemize. You might, but the odds are that you don't. So it tends to be a pretty well-heeled taxpayer who is itemizing. It tends to be someone who is a homeowner who has mortgage interest, or somebody who has massive medical expenses. So if you have a medical disaster this year, this might be a year that you do itemize. And of course, if you are giving charitable donations that are so large, like, $3 million to the Metropolitan Opera, then of course you're going to itemize, because that's going to way outshoot the standard deduction. All right. But for most of us, our charitable contributions go in this bucket, and that bucket is never big enough to outweigh the standard deduction, so we don't take it. Okay. So in general, when you make a donation to a nonprofit, it's lovely. You get karma. I'm absolutely encouraging you to put your money where your mouth is and make charitable contributions. But I want you to understand that in general, for most of you, you're not getting a tax deduction. All right. Well, with that bad news out of the way, let's talk about when you might get a charitable contribution, because I know this is the time of year you're getting all those letters in the mail about year-end donations. All right. Well, first you need to know that a charitable donation is only valid if it's to a, like a registered nonprofit. There's a lookup tool on the IRS website, and I can link to it in the show notes. It has to actually have gotten permission from the IRS to be a nonprofit. It's not just, your Uncle Joe. So that's important. All right. But here are some ways that you can, if you take the standard deduction, potentially still get some deduction for your charitable contributions. So one strategy can be to, if you look at what your itemized deductions are each year, and they're sort of close to the line of the standard deduction for that year, and you can know that this is true because you can go, usually if you've done your taxes, with software or through an accountant, there's usually a summary page that will give you a total for your itemizable deductions. Most accountants will do this. Most software will even ask you the itemizing questions up front because they're trying to get you the better deduction. So usually this info is recorded somewhere and you can find it. So I'll just tell you my own numbers from last year. Because it might be interesting to you. So I am someone who gives sizable charitable donations, and I'm someone who has a mortgage. And even with that, I don't itemize. All right. My taxes last year, when I looked at them, so this is 2023 taxes, I spent $18,000 on itemizable expenses. So that's state and local taxes, medical, charitable donations, and mortgage interest. And yet the standard deduction last year for a married filing joint couple was $27,700, right? So $18,000 versus $27,700. I didn't itemize. I took the standard deduction. But this year, Hurricane Helene happened, and I have been donating massive amounts of money to nonprofits in my area for grant relief funding. So here's a good example that might be helpful for you. If you find that you have a year where one of your itemizable deductions is outsized, so in a, maybe you're giving a ton to charity in a particular year, but maybe it's also a year where you have really high medical expenses, right? That might be a year where you're kind of close to the line on the standard deduction, going over your itemized deductions, going over the standard deduction. And for that reason, your charitable contributions for the year might put you over the top. Now, you're only going to really be benefiting the amount that they exceed the standard deduction, but Even so, if you donate a lot to charity, it's really nice to get a deduction for it. So what some people do is they kind of pack together big donation years. And then in the other years, they take the standard deduction. So you can kind of keep an eye. This requires you to sort of keep an eye on how big your itemizable deductions are for the year and how close they're getting to the standard deduction amount. But if you find that you're getting close, okay, maybe this is the year for a big donation to charity. All right. And of course, if you're a person in a position like me where you are not particularly hard hit financially by the hurricane and you really wanted to help neighbors and friends and you gave a lot of money to charity, this might be that year where you go over the top. And I will be honest to you, I can only report to you after I do my taxes, but I think for me, this will be a year where my family does itemize because I can already see from these numbers that we're going to have exceeded this with charitable contributions. Do keep in mind, though, the donations to individuals are not considered for charitable contribution purposes, right? That probably counts as a gift, but it's not going to count as a charitable contribution. So if you are a person who's been giving big donations because of Helene or Milton or other disaster reasons, but it's been in the spirit of mutual aid or giving money to individuals, not registered nonprofit organizations, then this money is likely going to be counted more as a gift and not as a charitable donation. The thing to know about gift giving is that the income, when you receive a gift, that is not taxable income, and you do not need to report it as such in your tax return. And when you give a gift, you also don't need to report it as a taxable donation. There is no deduction to be had for a gift. It doesn't go on your tax return at all, either on the positive side or the negative side. All right. So keep that in mind. And also, just FYI, I will link in the show notes back to my mutual aid episode, but I did sort of go over what all the mutual aid tax rules are. And that episode will really help clarify some of the finer points there. All right. So lumping your contributions into one tax year and then skipping other tax years, that's a good way if you're kind of a person falling in the border zone, like very close to the standard deduction amount that year. Another option, and I'm not going to get into it here, I can maybe do a future episode on it, but is a thing just to note in your files is a situation called donor advised funds. So donor advised funds are a way to essentially have an account that you can sort of get money flowing out of it towards charities, and the sort of setup, you have to do some setup on the back end, but through this setup, you're able to give charitable donations on an annual basis with a tax implication that doesn't necessarily come the same year that you give the funds. Okay, so just look up for yourself donor advised funds if that feels like an option that you want to look into. The other option that's pretty interesting, if you, and you probably are if you're listening to this podcast, if you have a small business, is that sometimes your charitable donation is really advertising. And advertising is a business expense, all right? Now, if you give a charitable donation and you want to put it on your business, on your Schedule C as a business expense, as an advertising expense, it needs to genuinely be an advertising expense. So this is not a place where you're making things up. But here's where a charitable donation actually really could count as advertising. So let's say I want to sponsor the swim team and I want to get Sunlight Tax printed on the swim caps, right? I can donate the money for swim caps, maybe suits, maybe towels, and I can get Sunlight Tax, my logo, printed on the swim caps and the towels. Well, that really is advertising. I am really putting my business information in front of an audience in that situation. Now, that is not something that I do in this case because the swim team parent crowd is not particularly the audience for Sunlight Tax. But I actually have given chunks of money to my kids' public schools. And those schools, because they have savvy PTOs, they will offer to print my logo on, like benefits that they're doing, or, like I can sponsor different events at the school. And so that sponsorship, I get to take it as a business deduction, an advertising deduction, because I've got my logo in front of a bunch of people at the school. And yes, those are creative. This is a creative town, and a lot of the parents are creative people. So a charitable contribution being potentially advertising is something to consider, something to think about. Another way that I personally have structured some charitable giving as a business deduction is donating to a organization who has values that are really aligned with Sunlight Tax, and promoting that donation as part of a promotion I'm doing, like as a component of a launch, to say, all sales that I get on X day, I will donate X% to the YWCA of Asheville, which is one that I have run several times in the past. I've also done events like that for other arts organizations nationally, either arts organizations that give economic help, or the YWCA, which here in Asheville does really wonderful job empowering low-income women with financial resources. And that feels so aligned with the Sunlight Tax mission that it's just kind of like an obvious choice for me to give Sunlight Tax money. Okay, so I hope that is helpful for you. I have one last thing I want to mention. When it comes to charitable donations, I want to talk about donating your creative work, because I know also a lot of charitable organizations have artwork sales, or might ask for you to donate to like a charity auction. So let me talk to you about what that looks like for you. When you yourself are the creator of a work and you donate it, I want you to understand something key, which is that your donation value is only the materials. Your labor is not deductible in any way. The value of your labor, though it may be great, is simply not something that can go in your tax return. So when I, as a painter, donate a painting, even though that painting might have a retail value of $7,000, the cost of that painting to me was, the cost of the lumber, and I make all my own stretchers. So the labor in my stretchers, even though they're gorgeous, is all labor and not much materials. So like stretchers, some canvas, some staples, and paint, right? That is not a very big cost when you compare it to the value of the painting in a retail setting. But there's even worse news than that, because anyone who's a professional, if your art is a business and not a hobby, you've already deducted the supplies. You've already deducted your materials expense, right? And the IRS is very, very clear that you don't get to double dip and deduct the same expense twice. So the fact that I already deducted those stretcher bars, that canvas, that paint on my Schedule C means when I donate that painting to charity, I get nothing. Absolutely goose egg. So for most professional creators, when you donate your own work, if you already deduct materials, you're not getting any deduction at all. Just none. I happen to think this sucks, but it is the truth. It is the law. So what I don't like here is when charitable organizations send you a letter with the retail value of your thing, or even the sales value of the item you donate, because it gives this implication that maybe that might be what you get to deduct. And I have seen people do that. And I feel like it's misleading for the charitable organization to do that. I think they should check on what the rules are when the self-created, when the creator themselves is donating, because it's a different rule from when I donate a work. Say I bought a painting for $7,000 and I donate that. Now my donation value is $7,000 because I actually paid $7,000 for it myself. When I'm the artist, what I paid is the canvas, the paint, etc. All right. So donating your own work has a real sucky quality to it. We don't get much credit for it under US tax law. Go ahead and make that your next pet issue if you are an advocate. I welcome that. And also feel free to share this episode with any organization that is soliciting offers of donated artwork or music or whatever your particular art is, and trying to imply that you get a deduction for it, because I don't think that's really ethical. Okay, so I realize that part about donating your own work is a bit of a bummer, but I hope that telling you about donating in the form of advertising with a genuine advertising purpose, that can be a way to do great charitable work in your community to spread dollars to places that you really, really care about and feel aligned with, while also getting an actual deduction for it. All right. Last but not least, because the deadline is coming up, I do want to remind you that there is a beneficial ownership information report due on December 31st. If you have an LLC, you are required to do this new absolutely mandatory filing. It's very quick. It only takes about 5 minutes. It's a quick, simple, incredibly painless filing. But if you don't do it, and it's also free, but if you don't do it, the fines start at $500 per day, up to $10,000, and you can get 2 years in jail if you don't do it. So the deadline is December 31st if you had an LLC that already existed. And I want to help you with this, so I made a quick little 15-minute mini course, which you can get at sunlighttax.com/LLC. In this short video, I walk you through me doing my own BOI report on the US Treasury website. So I literally show you how I'm doing mine, and you can just open up another tab as you watch the video and do your own filing alongside me. It takes most people about 5 minutes on top of watching the video, and it's really quick and easy. It's something you can take care of, get it off your list, and rest assured you will never experience fines or penalties or, God forbid, jail time. There has been some controversy about this law. On December 3rd, a Texas court did put an injunction. And so there's a little bit of question about people should file or not file. I personally recommend going ahead and doing the filing. It's free, it's fast. It guarantees that if you miss the news that this injunction gets overturned, you don't suddenly start incurring $500 a day fines, right? Who wants that? So if you feel super on top of your Google News alerts and you're happy to just keep an eye out for if that injunction gets overturned, do your thing. But I recommend that everybody who has an LLC who's subject to the law as written, go ahead and do the filing, because then you know you are not going to get in trouble. So you can get that little course, and it's totally free. I just want everyone who has to file this report to know that it exists, to know that they have to do it, and to be able to do it free and without any scams. So you can get my little course at sunlighttax.com/LLC. All right. Nice to talk to you today. Go forward and make those charitable contributions that help improve this world and put forth your vision and your power, your dollars into the places that you care about. And I will talk to you next week about the triple deadline of April 15th and how to make it easier. All right, see you next week. Bye. Thank you for watching. If you like this video, be sure to like, leave a comment, and subscribe to my channel. I'm so grateful for that. This video is for education and entertainment only. Nothing in this episode should be taken as individual tax or financial advice. You can find all the tools, books, and links I reference at sunlighttax.com/podcast.